Alibaba stock cannot catch a break. This is a company that is down 37% over the last year, trading now at its 52-week low just above the $70 mark, a yield of 1.4% and a forward P of just below 8. Now let's take a look at the historical performance of this company. Let's take a look at the income statement, see what is going on their top line as well as their bottom line, why this company is being plummeted share price wise when they have a strong performance. Let's take a look at the health of the company, their total cash versus their total debt based on their latest earnings. And let's look at some of these companies, some of their competitors, whether or not this is an industry-wide thing or something simply isolated to Alibaba. We'll also look at some financial metrics, analyze their dividend. We'll also take a look and see what US Congress members are doing. Are they buying or selling this stock? And as always, we will see what the institutions are doing. Are they also buying or selling? And we'll touch upon some articles that discuss the issues surrounding Alibaba and why they see this drop in the price. Finally, we will also run them through our valuation model, getting to our intrinsic value as well as our acceptable buy price given our investor margin of safety, and seeing what Wall Street have in store for this company in terms of their targets over the next 12 months. Now, it does look to be extremely undervalued, and we'll touch upon that when we look at the valuation. But if you have been holding this even over the last 10 years, you can see the all-time high sitting around $310. So this has come down a very, very long way. Now, when we take a look at their income statement, what we typically look for is 3 to 7% growth to the top line. 56 billion reported in 2019, 126 billion in 2023 March, their latest annual report. So we're talking about a company that has doubled or more than doubled their top line over the last 5 years. On a more granular level, they've increased their top line year on year up to 2022. We do see a slight drop into 2023, but nonetheless, they have increased their top line rapidly, although we do know one or two inconsistencies. On the bottom line, a slightly different story to be told. 13 billion reported in net income in 2019, 10.6 billion in 2023. So whilst their top line has in fact increased dramatically, their bottom line has decreased from 13 billion to 10.6, although we do note it did increase up to 2021 before decreasing and then picking back up slightly. So a bit of an inconsistency there. Their top line has increased pretty strong, more than 2 times, whilst in fact their bottom line net income has decreased. So a bit of a red flag there that we can consider later. In terms of total cash versus total debt, 30.3 billion cash in 2019. Their latest quarterly report showing that they are sitting on a ton of cash, 79 billion. So this is a company that not only had a large cash position 5 years ago, but has essentially more than doubled that over the 5-year period. In terms of total debt, let's compare that numerically and directionally over the last 5 years. And what we can see here is that their total debt, whilst it has increased from 20 billion to 27 billion, it is still significantly lower than their total cash. So this is a company that has a very strong balance sheet. They could, if they wanted to, pay off all of their debt and still have a significant cash balance. Now, let's take a look at some other companies in the broadline retail industry. We have PDD, another company in the same industry. We have Melli as well as a few others that I'm sure you would have heard of. Now, over the last year, Alibaba is down 36%. In fact, whilst that is pretty terrible, it isn't the worst performing in the industry. We see JD, another Chinese stock, down 60%, although we do know other ones like Melli up 62%. Now, when we expand that over the last 5 years, we can see that still Alibaba, one of the worst performing, but you do have others up significantly higher. So this isn't an industry problem. This seems to be a problem isolated to the company. And let's find out whether this is something that is also isolated to the Chinese market. Now, before we do that, let's just have a very quick look at what Congress have been doing. Now, interestingly, in the more recent period, we have a US Congress member here, Laurel Lee, selling around $100,000 to $250,000 amount worth of shares at around $77.51. So it is very interesting to note that the last Congress buy, in fact, was the beginning of 2022. at $131. So there isn't much buying going on over the last year. In fact, a lot of selling of around $250,000 worth by US Congress members, which is always interesting to note. Doesn't necessarily mean anything, but it is nice to add as part of the evaluation. Institutional ownership then, 14.22%, with around $6 billion worth of sales by these institutions over the last 12 months. We can see over the same period, slightly more buying, around $9.36 billion. Now, over the more recent period, Q4, we see a little bit more selling, 60 million versus 13. Q3 the opposite, and Q2 again the opposite. So very inconsistent, but if we're looking as a whole over the last 12 months, more institutional buying than selling. Now, before we jump into the metrics, let's have a very quick look from this article. Now, there's a few things to note here. Alibaba are focusing on their Chinese platform. Now, I cannot pronounce that, but that is on screen. And we can see that their Q3 revenue growth is slower than expected, hence why, even though the share price was already very low, it has started to come down even more. Now, essentially what they're looking for to doing is undergoing a strategic change in their operation, focusing on their Chinese online platform, mentioned here the name. Now, this essentially they believe will lead to a decrease in their revenue than initially they had projected, which isn't great, especially when this company is looking for positive news to turn around that share price. And we can see they are also expecting issues in terms of their offline grocery business. So a lot of issues being mentioned here, and they're saying if Alibaba does continue its high-level international digital commerce investment cycle, it could face even further risks. So a lot of issues being brought up here, nothing really positive. We can see that share price continues to be suppressed, yet they didn't have a bad income statement. We saw their top line increasing fairly positively over the last few years, as well as a fairly healthy balance sheet when we did take a look at that very large cash position, as we saw here, from 30 billion to 79 billion. Now, they also mention or reinforce that their revenue growth predicted to be slower than what they had previously estimated, essentially due to this small group unit and customer management revenue. So not great at all. Now, let's take a look at this article again from only a few days ago. Now, what they're essentially saying is their valuation is incredibly cheap. Alibaba is trading at half the valuation of a utility company in Hong Kong, I believe. Now, it's not the same. You can't compare the essential valuation of two companies, but it is trying to reinforce how cheap Alibaba is pricing at right now. And what they're saying is, as we have mentioned on the channel before, the valuation has halved in the past year. Now, it isn't for no reason. We can see sluggish online sales, a lot of fierce competition, as well as skepticism over the future business. Now, what they're essentially saying is the business is trading at 7.6 times their estimated earnings for the next 12 months, which is very, very cheap if you believe in this company, whereas the utility company is trading at 13 times. So it is saying this is a bit of a joke, in essence, how cheap this company is trading at. Now, just because it is important to note a company is trading at a perceived cheap price, it doesn't mean it is a buy now. You always need to understand all of the risks, including the regulation risk as well. And we can see it is down 77% from its recorded high, as well as the fact that their main rival, Tencent Holdings here, they're trading for half of the valuation. Now, there's a lot of different things to consider, a lot of information. So now let's focus purely on Alibaba, the business itself. Now, 1.36% dividend yield, 180 billion market cap. Now, when we analyze essentially their free cash flow payout, remember they are only recently starting to pay out dividends. As always, ignore the earnings data. It is susceptible to manipulation by management through accounting. 11%, so not that much in terms of the payout ratio for the dividend. So I would like to see a very high double-digit increase to that dividend this year. Free cash flow payout, phenomenal, $10 in 2014 to $63 in 2023. Expect to go slightly higher in 2024. Yes, it isn't consistent increases. We see that large drop in 21 to 22, but the positive sign is it has bounced back straight up. So that is a positive sign for the business. Sales growth, a few things to consider here now. Yes, very, very strong double-digit increases year on year. In fact, up to 2023 where it posted 2%. Before then, it was very strong. Now, yes, it is positive, but the other thing to note here is given how low it dropped in 2023, is there an issue now that Alibaba has done all of its growth and it is slowing down? and should we only be expecting single-digit growth to the top line, as that will be a very big factor to take into account when trying to analyze and value the company. Total sales then, just to put it numerically, 53 billion in 2014, 869 in 2023, 915. So they're not far from reporting 1 trillion in sales, which would be absolutely phenomenal. Now, they've done share buybacks as well as share issuances, but over the course of the last 10 years, they would have diluted your position as a shareholder, going from 233 billion to 2.64. So something just to consider there. ROIC, as always, it is one of my 7 golden dividend metrics. 10% or more gives me faith management are able to effectively allocate their capital. For the large part, it has straddled around that 10%. 8% in 2023 is okay, I can live with that. I would like it to be a lot higher, double digits at a minimum, but as we can see, it is still fairly strong, not too far off the minimum. Operating margin and free cash flow margin, I'll just talk about them both together. Very strong at the beginning of the last 10 years, but as we can see, it is coming down. Now, this is a worry when I look at their sales. They had phenomenal growth to the top line, but as the years have gone on, we can see their margins being suppressed on both the free cash flow as well as the operating. Now, the free cash flow itself, 19% in 2023, even 11% is still fairly positive, but it's just the nature of the way that the margins have been suppressed does make me question whether or not it should be valued as highly as maybe analysts are thinking. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the dividend safety as well as the balance sheet strength. We've already mentioned this earlier. I mean, this just shows the number of years it would take the company to pay off all of their debt net of cash on hand. Wouldn't even take them 1 day. So they have a phenomenal balance sheet. And now let's jump into the valuation. As always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Don't forget, click on that pinned comment below where you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list. Now, the first model that we're using is Graham's valuation. Now we have the stock ticker symbol, the earnings per share, long-term growth rate, and as we can see here, when we use that with the current yield on AAA corporate bonds, we're getting an intrinsic value of $108, so we can see our first sign and signal of undervaluation. Bear in mind that we don't look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. Then we have the multiples valuation model, PE multiples of them all, get the average multiplied by the earnings per share of Alibaba to get a market value of 71 in comparison to the intrinsic value on the multiples valuation of 127, another sign here of undervaluation. We then would typically use the dividend discount model, and that's the first year that they are paying out a dividend, so it isn't one that is applicable. We can use it maybe next year once they have had a year or two of paying dividends under their belt. Now we move on to the DCF model with the free cash flows year on year. We have the average growth rate of 29.53%. Now, I have gone super conservative at 1%. As always, if you grab a copy of the model, you can play around depending on your own investment thesis. But this is significantly lower than analyst estimates, and I just wanted to be a lot more conservative in the estimations. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide by shares outstanding, we have that intrinsic value of $215, significantly undervalued. So it should come as no surprise the intrinsic value will show it'll be significantly higher than the market value at $150. Now, margin of safety, as always, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And what we can see here is an acceptable buy up to $135. Now, it comes as no surprise, it's still a buy at a 30% margin of safety and at 40%. And when we go to 50%, it isn't too far off the current trading price. So right now, because of 55% says sell, it is trading at a 50% margin of safety. Now, what do Wall Street say? Wall Street see this share price going up to $126 over the next 12 months. They see a whopping 75% upside in Alibaba Holdings. Now, before you run off and invest in this company, you need to do your own due diligence. You need to understand that there are a lot of risks with this company, not just the business itself, but also not the economy, the regulation risks. So there are a lot of different things to consider. And also we have seen that their revenue is expected to grow slower than previously had anticipated. So just a few things that I would consider that you need to think about. Their top line revenue has started to decrease from the growth we have seen before. Their margins are becoming more suppressed as the years come on. So again, just a few things to note. It does look to be extremely undervalued, but it doesn't go without its own risks to consider. As always, though, it does seem to be a company that every time we review on the channel, it goes cheaper and cheaper, or the price drops further and further, I should say. But as always, let me know your thoughts in the comments below. If you've enjoyed the episode, smash the like button, hit the subscribe and bell button. Don't forget to click on that pinned comment, grab a copy of the valuation model, and I'll see you all on the next episode. Take care for now.